I've been at the Minneapolis Fed for 2 years. It's been a terrific experience so far, and Minneapolis, the Twin Cities, are a wonderful community, very welcoming, and actually very high quality of life. And I'm sure we're going to talk about the economic environment, but it's a remarkable place.
I don't want to tell everybody what they already know, but the amazing thing about the Minneapolis area, and I'm going to focus on this because I know people are watching us on the live stream, there are an enormous number of important national and international companies based here. You're not overseeing a district that has no importance to the American economy.
No, absolutely. And one of the things that's really interesting about our region, so the Federal Reserve, the country is divided into 12 Federal Reserve districts. And if I can just take a moment, give you a little bit of American history, our country has always hated the idea of having a central bank at all because it just sounded very undemocratic. Alexander Hamilton created the first central bank, then there was a second central bank, then they got rid of it. Then the US economy was hammered with banking crises in the late 1800s, then a really big one, the banking panic of 1907. At that point, Congress said, we still hate the idea of having a central bank, but I guess we have to have one. But if we have to have one, we don't want it all concentrated in Washington, D.C., under the thumb of the executive branch. We want to distribute it around the country. So that's why Congress in 1913 created the Board of Governors that you're familiar with Jay Powell as the new chairman of the Board of Governors, appointed by the president, confirmed by the Senate, and then 12 independent regional Federal Reserve banks that are governed by local boards of directors of local leaders. So importantly, I was selected by the local board of directors of this region. I report to them, and that is literally part of the checks and balances that Congress thought was so important back in 1913, so that our central bank is distributed around the country. So that's why there's a Minneapolis Fed here, and our jobs are to represent all of you, to get to know the region, understand what's happening in the local economy, and bring that perspective back to Washington, D.C. when we set monetary policy for the nation.
Well, let's explore that a little bit, because I don't know if you know this, but there are still people who don't like the Fed.
I don't believe
out
it.
There in the country.
Most of them are on Twitter.
And after our interview today, I heard from a number of them. Tell the people here, when you say you represent their views, what does that mean when you're in Washington?
Well, when we go and we meet for FOMC meetings every 6 weeks, we have to set monetary policy for the nation as a whole because it's one currency for the whole nation. We can't target it to certain regions or certain states. So in some sense, I'm looking at national data to make my recommendation on what's the best course of action for the United States of America. Having said that, it really helps to understand that data by having conversations on the ground to make sense of what's happening here and to match that up. If you're just looking at the raw reports that coming out of the Bureau of Labor Statistics or other national agencies, they're fine, but you can't get a sense of what they really mean. For me, unless I'm out there talking to businesses large and small, what are you seeing? What are the challenges that you're facing? How are you making decisions? So a perfect example of this. A big debate that we've been having for the last several years is, are we at maximum employment? Are we at a place where if the economy's pushed any harder, it will lead to inflation because there are no more workers available? So I always ask businesses large and small, are you able to find workers? Usually the answer is no. Then I'll ask them, well, are you raising wages? Usually the answer is no. So then I say to them, well, you're not serious, right? You want more of something, but you're not willing to pay more for it. That's just whining, right? Everybody wants more of something for free. So it's these conversations that help me make sense of the data that we're seeing nationally and then make the best recommendation that I can.
Well, I'll ask you the question, paraphrase my old friend Ed Koch. How are we doing? How's the economy doing?
I think the economy is doing very well. I've been surprised at the amount of confidence and optimism that the tax cut has led to. In conversations that I'm having, people genuinely feel more optimistic now than they did 6 months ago. And in large part, I do think it comes back to the tax cut. Now, the question is, and this is for you as much as it is for me, is that going to lead to an actual change in behavior? Are people actually going to make different investment decisions now than they would have made 6 months ago? I don't know the answer to that. And generally, people feel more optimistic. You'd think they would invest more, but that is not clear to me how much of a long-term difference it's going to make. Is it going to be a short-term stimulus? We know if the government just borrows more and spends more, that's a stimulus. Or is it actually going to lead to greater investment, higher productive capacity? That we don't know yet. At least I don't know.
If you look at the capacity utilization statistics in the U.S., especially for manufacturing, capacity utilization, the amount of your factory that you're using or your productive capacity that you're using has been running below the long-term average. We haven't been pushing up against the ceilings. So what are companies telling you about the need to invest more at this point to deepen their capital?
Well, again, it's very mixed. Some are saying, well, we can't find the workers that we need. We can't find the workers with the skills that we need, so we're going to turn to automation, if possible, to make up that productive capacity that they feel like that they need to have. But let me just share with you, a lot of the key concepts that we focus on for monetary policy that we really don't know for sure. I'll give you an example. We don't really know what is the natural rate of unemployment, the unemployment rate that below which triggers inflation. We don't really know. Are we really at full employment today? We don't really know. We have to make estimates of that. We don't really know where the neutral real interest rate is. So over the last 30 years, interest rates in advanced economies have gradually been falling as a result of broader macroeconomic factors. So the interest rate that clears savings and investment varies over time. We don't really know where that is. We have estimates. We know it's low. Is it zero? Is it slightly positive? We're not sure. So there are a lot and the output gap, the third concept. Some economists think the U.S. economy right now is operating above potential, that it's not sustainable what's going on right now. We don't really know. So these are three fundamental concepts that we have to make judgments on each of these, and they all relate to each other when we try to estimate the right path for policy. So I'm not trying to punt your question. I'm being honest with you about some very fundamental concepts that all we can do is make our best estimate on, look at the available data, and then adjust as new data comes in.
Well, let's take a part of the idea of the output gap, both pre-tax and post-tax cuts. And that is, we know what essentially potential growth is. It's the labor force growth, which is about 0.5% a year, and productivity, which has been remarkably low, running maybe 1%.
Correct.
So between 1.5% to 2% is the potential growth rate of the economy. Absent tax cuts, would that have increased significantly, do you think? And now that we have the tax cuts, what's your best guess for how far that could rise if it does?
Well, if the tax cut is simply fiscal stimulus, which is a temporary boost to spending, then you can have a short-term increase beyond that potential that you're talking about, but you're just going to be borrowing to drive more spending. It's not going to lead to a structural shift up in growth rate. So I like the way you broke it out. Labor force growth, we know what that is. Now, there may still be some slack in the labor market, and let's hope we can use that up in the next year or two and get all Americans who want to work back in the job market. That is what it is, just based on demographics, right? We know that. Our fertility rate is lower than it was a few decades ago, and that's simply math. So unless we have a big surge of, we have fertility goes back up, or we turn to immigration, the labor force growth rate is basically flat where we've been in the last decade. The other unknown then is productivity growth. As you said, productivity growth has been very low the last decade. This is fiendishly difficult to forecast. Could there be some productivity breakthrough around the corner? It's certainly possible, though we don't see it immediately on the horizon. So the best hope for the tax cut is that it leads to greater investment, and that in turn leads to a productivity boost, which then leads to greater potential for the economy. There's a lot of maybes, hopes, and wishes between here and there.
What's the best scholarship you hear on the idea of raising productivity, especially if companies have more money to invest, if they invest it? I mean, you talk to the economists in Washington at the Fed, and you've got your own at the Minneapolis Fed. What are they telling you about the possibility of a higher productivity rate?
They just tell me it's impossible to predict. We just don't know. I mean, we don't actually have a good answer for why productivity growth has been as low as it's been for the past decade. There's some professors out there who think it's because we've invented all the big stuff. There's a professor at Northwestern, Bob Gordon, who wrote a book that got a lot of attention. 100 years ago, the global economy was inventing electricity, the internal combustion engine, the airplane, and then the integrated circuit. Right? Compared to those transformational inventions, Twitter and Facebook are rounding errors, right? So what's the next big thing? We don't know. Maybe it's going to be self-driving cars and trucks that leads to a big boost in productivity. It's possible. We just don't know. And so that's what's hard. And I think for all of us to say we're going to have a productivity rebound next year or in the next 3 years, I hope so. but it's going to be wishful thinking at this point.
I don't want to steal your thunder and tell people what the Fed does, but I know you make policy based on forecasts rather than what's happening right now, because monetary policy works with a lag. So what's your best guess as to 12 to 18 months from now, where the economy is going to be, where unemployment's going to be, where inflation's going to be? In other words, how many times are you going to be raising interest rates is the bottom line question that all these people want to know.
And I have a personal policy, because there's 12 Federal Reserve Bank presidents, up to, when the board is full, up to 7 governors, including the chair. So that's potentially 19 people out there giving talks and making predictions, which in my view adds to a lot of noise. So I have a personal policy of not making predictions about this many rate hikes or that many rate hikes. But I will tell you, and I publish very detailed essays explaining my thought process, here's the data that I'm most focused on. So for the last 8 or 10 years, we've been coming in low in our inflation target. We keep predicting that inflation is around the corner. We keep getting surprised when it doesn't emerge. So I've been advocating, let's just be patient. Let's let the inflation build, and then we can respond to it. From a risk management perspective, we have very powerful tools to lower inflation, right? We can always raise rates. We have very limited tools to boost inflation, and the Fed's been struggling with that the last several years. So that's why I'm very focused on wage growth. Are wages finally going to start picking up? If those wages pick up, is that going to translate into inflation? Is there still slack in the labor market? Those are the key metrics that I'm looking at to try to determine what's going to happen to inflation, and therefore what should happen to interest rates.
Well, let me ask a question to everybody out there to set up the next question. Is how many of you, we've seen in the purchasing managers' reports that more companies are at this point reporting that they're having to pay more for their inputs, their raw materials, and they're still not able to raise prices. How many of you out there think we're going to see more inflation? Raise your hands if you think we're going to see a lot of inflation. So it looks like inflation expectations are pretty low. And I set this up because I know you've been concerned about the Fed's role in setting inflation expectations, because a lot of people at the Fed say that's what drives inflation.
Well, one of the things people ask us, what are we going to do with interest rates low if there's a future downturn, right? We know there are cycles to the economy. There's going to be another downturn in the future. Are we out of ammunition? Can we respond to it? One of the costs of allowing inflation expectations to slip lower is that erodes our firepower to respond to potential downturns. So that's why some people are out there saying we should raise our inflation target. I'm not in favor of raising our inflation target from 2% to 3%. I want us to actually hit our 2% inflation target. To me, if we can actually hit our 2% inflation target, that will be a positive development, and that will give us a little bit more room to then respond to future downturns.
You've suggested that we should also realize that the Fed, when they say 2%, is not talking about a ceiling. They're talking about an average, and that you can go above it. How far would you be comfortable with inflation rising above 2%, and for how long?
Well, so we've been roughly, if you look at core inflation, we've been at roughly 1.5% inflation for the past 5 or 6 years, ballpark. So that, to me, if we've all agreed at the Federal Reserve, we've all agreed that our inflation 2% is a symmetric target, which we can go equally above or below. So if we've been willing to tolerate 1.5% for 5 years, the math says we should be able to tolerate 2.5% for 5 years, so we can average 2% over the long term. That type of a philosophy, that's how I interpret a symmetric 2% target.
Now, some of your colleagues would push back and say, yes, that makes sense, except once inflation gets above 2%, starts moving higher, you can't necessarily stop it at 2.5%. You're either going to see it go way up, or you're going to push it way back down again.
Yeah, there's no evidence of that. I call these ghost stories, right? I can't prove to you that there's not a ghost underneath this table. I cannot rule it out, but there's no evidence that there's a ghost underneath this table. And so one of the exercises that I've done with my staff in Minneapolis is we've gone through every economic cycle for the last 50 years and looked at what's happened to inflation, what's happened to inflation expectations, what has been the policy response. And a lot of people are worried about a repeat of the 1970s, where we had stagflation, very high inflation. The 1970s did not happen overnight. It happened over many years of high inflation, and instead of raising rates, the Federal Reserve cut rates. What ended up happening is over the course of a decade or more, the political independence of the central bank was compromised, and they were making decisions to please politicians rather than what the data told them to do. They ignored the data and did the opposite. I can tell you this, we may have our policy differences around the FOMC table. 100% of us are committed to the independence of the Federal Reserve. So I have no fears about any of us, let alone Jay Powell, the new chairman, compromising the political independence of the Fed. We will respond if inflation starts to show itself. And so I'm just not worried about it.
Do you fear the opposite, that too many people on the Fed would want to raise rates too fast because they're afraid of inflation and then slow down the economy?
Well, I think that's my interpretation of why we've been undershooting our inflation target for 5 or 6 years. I think people do have memories of the 1970s, which was a very bad experience for the country and for the Federal Reserve. It was a policy error by the Federal Reserve, a big one. People don't want to repeat that. So I understand what's motivating that, but I also look around the table and say to folks, hey, I have great confidence in all of you. We're not going to let that happen.
Market-based measures of inflation are starting to rise. We saw a fairly broad-based increase in a lot of the categories in the CPI. And of course, we had the famous increase in average hourly earnings in the January payrolls report. So do you think that we are starting to see nascent inflation build?
Well, we're seeing some signs of it, and I'm in no way am I dismissive of that. But I also know that these monthly readings, sometimes they go up, sometimes they go down, they tend to reverse themselves. It takes more, for me, it takes more than 1 month's data to draw any definitive conclusion. So let's acknowledge the data, let's keep watching it. The fact that the market-based data is creeping up and some of the CPI measures have also crept up, at least that's confirmatory, they're confirming each other. So let's pay attention and let's be patient.
When do you think you would want to raise interest rates? You're not a voter this year, but last year you voted against all 3 of the Fed's rate increases. What would it take to convince you that rates should go higher?
I want to see definitively that we are moving towards our inflation target. I'd like to see that inflation expectations are in fact creeping up as an indication that in the future we think we're going to be back at target. Some more signs that maybe there's wage growth, more signs that we really are approaching maximum employment, right? If you look, one of the key measures that I look at is the prime age labor force participation rate. So the percentage of Americans between 25 and 55 who are in the job market. They either have a job or they're looking for a job. That number is still below where it was before the financial crisis. Now, if you look at Europe, if you look at Japan, if you look at Canada, their labor markets by that measure have already recovered. Ours has not. So we continue to be surprised how many more Americans want to work, which is a good thing that they want to work. It's a good thing for them, it's a good thing for the country that they're able to find jobs. We don't yet know how many more out there want to work. Maybe another million are waiting to come in off the sidelines. I certainly don't want to cut that off early. I want to let them find jobs.
Let's talk a little bit about the impact then of tax cuts on your deliberations, because I know that's of interest to everyone here. When you sit down in March to talk about whether to raise interest rates or not, what's going to be the discussion around the table? We saw that in the minutes of the January meeting that were released today, that there was concern expressed, not concern, but there was a feeling that growth was going to be faster this year, and that could lead to more inflation. What do you think by March we're going to know, or what's the general feeling going to be?
Well, I think we're going to have one or more inflation readings of PCE, which is the other inflation measure, personal consumption expenditures that we primarily focus on. We'll have PCE, and I'm not sure if we'll have another CPI by then. We'll also have market-based measures, which you also mentioned, of inflation expectations. Those should give us some signal on how people are interpreting the tax cut. We'll have whatever data we have on investment to see if investment is in fact picking up. And labor, the job report as well for February. I got to remember when that comes out, if we'll have that before the next meeting. So all of these are going to be pieces of data that we're going to try to put together to get a story on what's the outlook for the economy. Again, not just for the next 12 months, for the next 2-3 years. We do expect this year to be a bump because of the tax cut. But again, is it just a stimulus, or is it actually going to lead to greater investment and a greater productive capacity for the economy? That, I think, we don't know yet.
Do you think it complicates your job?
Perhaps. We look at anything that affects the U.S. economy. So if Congress passes some fiscal policy, we will analyze it to try to see what it does for the U.S. economy, what happens around the world, what happens to currencies. There's a feedback loop back to the U.S. economy from the currency market. There's a feedback loop from the stock market back to the U.S. economy. So all of these are inputs that we're always trying to gauge. and see what do they mean for the path of the U.S. economy. So I don't think it complicates things more than normal.
You told me this morning that the big companies in your district that you speak to are sort of wait and see mode about whether they're going to spend a lot to invest. I want to ask about the smaller businesses and the pass-throughs that were mentioned earlier. The NFIB surveys show a lot of enthusiasm and small companies saying it's a great time to expand. Are they telling you that they're actually going to do it?
That's been very mixed. I've heard some anecdotes where people said yes, other people said they're waiting. I mean, generally speaking, especially for big companies, the idea that a big global company had any trouble accessing the capital markets 6 months ago or a year ago, of course they could access them at record low, cheap rates. So if they had a good investment opportunity, they were not cash constrained to make that investment opportunity. The tax cut has not changed that. And so that's why I'm skeptical that all of a sudden these big companies are going to turn around and go make these big investments that they were waiting for before. Even for small companies, generally speaking, in most small business surveys, they had pretty good access to credit in the last few years. So again, I'm asking the question, unless the tax cut really changes their hurdle rate, for lack of a better word, I'm not sure that it's going to lead to a dramatic change in investment. But I hope it does. I mean, I hope it leads to more investment. That would be good for the U.S. economy as a whole.
One of the issues involved in the tax cuts was who gets the money. We all get more money in our paychecks, but especially with the repatriation, and the corporate tax cuts, does it go to labor or does it go to capital? And there's a great disagreement between a lot of economists and the administration economists about what happens. What's your feeling from the businesses you talk to? Do people seem inclined to give labor more money, basically, to raise their share of corporate profits, or is it more likely to go to the owners of capital?
I think it's more likely to go to the owners of capital. I mean, this is a trend that economists have analyzed over the last several decades on capital share of income versus labor share of income. And labor share of income since the 1970s has just been declining for a bunch of reasons, and we're not fully sure why. Some people speculate it's the decline of labor unions and their power. Some people speculate it's increasing technology and automation. Some people speculate it's increasing globalization are all factors in driving more of the investment returns to capital. I think that trend, I don't think the tax cut changes that trend. I think that is going to continue. And my interpretation of the one-time bonuses that we're seeing, I mean, I do think that they are in response to the tax cut. I also think companies are responding to the political environment that they're in, and they generate goodwill with employees, they generate goodwill with their customers and with their communities. There's nothing wrong with that. But I would guess a year or two from now, when you add up the total dollars that went to share repurchases and dividends and the total dollars that went to actual increases in workers' compensation, I'm guessing the lion's share will go to capital dividends and share repurchases rather than changing wages.
Well, the idea that labor would get more was one of the administration's arguments for doing corporate tax reform and the repatriation. The other is that it will bring factories back to the United States. Do you see any evidence that that's going to happen?
You know, not yet. Again, if you think about repatriation, the companies that have these giant cash balances abroad are big global sophisticated companies that can access capital markets wherever they want. So Apple is not cash constrained. If Apple wanted to build a factory in Minnesota, Apple could have done it any time that they wanted to. They didn't need a tax cut to make that happen. They didn't need to unlock cash that was somehow trapped abroad. So I would be very surprised if it leads to a material shift in where businesses are locating themselves.
Let's shift gears a little bit, because you brought up an interesting topic when you talk about Apple building a new headquarters if they wanted to. Amazon is going to build a new headquarters. There's a campaign out there to identify the winning city. You've warned that this may be something of a poison chalice for the city that wins.
Well, the question is, how big a check is the city going to write, right? My guess is, I don't know this for sure, I've never met Jeff Bezos. My guess is Jeff Bezos knows where he wants to put his headquarters, or maybe 2 or 3 cities that he already down selected, and says, well, how do I get them to write the biggest check? Well, create this little competition and have all the cities compete, the states compete to write the biggest check. And it's a windfall for shareholders. Depending how big the check is, it may or may not actually be a net positive. There might be a winner's curse. It may not be a net positive for the city that ends up having to write that check. You see these with stadiums, with the NFL, et cetera. You see it with businesses. They're all acting shrewdly in their shareholders' interests. That doesn't necessarily mean it's a winner for taxpayers.
Another topic that is getting a lot of attention, particularly would be important to the people in the Minnesota area, because just up the road is another country. Trade, NAFTA. How concerned are you by what's going on in the renegotiation process? Are you worried that we lose the free trade agreement? And if we did, what impact would it have on your district?
Well, I think free trade is enormously important to the country and to our region. We have a lot of exporters in and around in Minnesota and in and around the 9th District. So free trade is enormously important. My hope is that the country gets how important free trade is, and that if the renegotiation goes forward and they can renegotiate a better deal that works for us, great. I would be very concerned if we were going to start wholesale walking back away from our free trade partners. I mean, we do so much trade with Canada, so much trade with Mexico. They're enormously important to the U.S. economy, and we're enormously important to their economies. We need free trade that works for both, I get it. But if we go to a position of trade barriers with Canada and Mexico, I think we're going to be hurting ourselves.
You think it responds to the concerns of people who feel they have been left out of the globalization of the last 20 years?
No, I understand that, and I don't make light of the challenges that they're facing. But I can tell you this: an economy that is simply growing more slowly because we do not have access to global markets, nobody's going to be better off. Nobody in America is going to be better off if that ends up being the outcome. So we must avoid that outcome.
I want to leave a little time for questions from the audience. So let me ask you just a couple more things, and then we'll let you all have a shot at Neel. Let's talk about financial markets, because obviously February, rough month for investors in equity markets, and we saw changes in what was going on in foreign exchange and in the bond market as well. What's your read on markets right now?
I think people are trying to figure out the same things we're trying to figure out. What's the path of inflation? What's the path of wages? What's the tax cut going to do? There's a lot of uncertainty. Nobody knows for sure. And so I think we're all trying to read the same set of data and make judgments about that. And so that's underlying why I think markets have been volatile. And as I said to you this morning, I don't think we as policymakers should be responding to every up and down in the market. Markets go up, markets go down. We need to try to take a longer term view on the trajectory for the economy when we make our decisions.
The Fed has responded, though. 2013, the taper tantrum. 2016, the Chinese market meltdown. Fed held off on action. Do you think that the Fed is still more responsive to markets than it wants to be?
I think there's probably some truth to that. I mean, I think we would all like to be pay less attention and not be whipsawed by markets. But we also know that markets do have a feedback loop on the U.S. economy, both through confidence, through the wealth effect, et cetera. So, we can't be completely blind to what's happening in markets. But again, I think we need to focus on the long term. What's the outlook for the U.S. economy over the next several years, and make our best judgments based on that, not based on, imagine if the Fed had responded to a 1,000-point drop in the Dow, and then a week or two later it made up most of those gains. Then what, the Fed should go back and reverse its decision? We'd be chasing our tails if we try to do that.
Well, do you think the drop in equity markets over the last month says anything about the economy?
I don't think so. I think it's more just trying to make sense of what's the path for, I may be overly influenced because these are the glasses that I look through. What's the path for wages? What's the path for inflation? What effect is the tax cut really going to have? That's what I think the markets are focused on, and that's what I'm focused on, and we don't know for sure. So let's let the data come to us.
Is there a new paradigm, though, for the bond market? Have we seen yields bottom out, and now we're going to see, after many decades, we're going to see them do nothing but rise?
Oh, I don't know. I don't know about that. We've had the bond market, yields have risen in the last 5 years before, and they've turned around again. Again, look over the last 30 years. Interest rates, long-term interest rates, have gradually declined over the last 30 or so years, largely not because of us, not because of short-term interest rate moves, because of broader macroeconomic factors like demographics, like productivity development. Those things go into the savings and investment decisions of the market economy that we all live in. Those trends are ongoing. And so are we going to all of a sudden revert to a very different savings and investment balance that we maybe had 20 or 30 years ago? I'd be surprised by that.
And let me open it up here now to anybody who has a question that they would like to, and I saw one hand go up immediately back there to ask Neel, and I'll try to repeat the question for the camera since I have the microphone on.
Sure. One thing we haven't talked about is the debt load that the American society is holding on to, and I'm interested to hear about what the Fed thinks about tax reform came at a big expense to the deficit, and infrastructure may do the same thing. So what does the Fed view, America's debt ceiling and punting down the road that just recently happened? How does that factor into monetary policy?
Shorthand question for the people watching. Tax cuts mean bigger deficits. How does the Fed feel about that?
Well, long term, there's no question we have to get our fiscal house in order. And we cannot run ever larger deficits forever into the future. At some point, global investors will say, we have better alternatives and we want to invest elsewhere. So that's the long-term risk, and that really is, it's about the taxes, but it's also about things like Social Security, Medicare, and Medicaid over the long term. So clearly, it's a very important long-term issue. In the short term, it's not something I think that is an immediate risk for the U.S. I think the U.S. economy is still the strongest in the world. We still have the strongest debt markets in the world, so it's not something we're immediately focused on. But I'll also say, ultimately, this is not the Fed's role. Ultimately, that is fiscal policy. That is up to the Congress and the executive branch to decide how much they want to spend and how they fund their spending, whether it's through taxes or through borrowing or whatnot. And so that is really outside the scope of monetary policy. But over the long term, I think we would say it does matter.
Another question? Yes, sir.
Yeah, Neel, one of the things that's not been touched upon, but in talking to our clients at Grant Thornton, CEOs, et cetera, there's a real strong belief that even bigger than the tax cuts, 35 down to 21% for C-corp capacity, and this doesn't make the Wall Street Journal every day because it's done through executive orders, is the regulatory rollback. Just curious if you all, the 12 of you, talk about that when you're doing monetary policy, because there's a sense that, okay, this year, the tax reductions will have a spurt for calendar 18, but 19, 20, 21, there's a bullishness that you acknowledged half an hour ago, but the deregulatory rollback they're saying is even bigger than the Reagan years in 1 year. So that's gigantic with our clients, C-suite. I'm talking about business people.
Yeah.
All right, the question on regulatory rollback that the administration is engaging in, how does the Fed see that? What impact is it going to have?
Well, we hear this as well from businesses that we talk to, large and small. Again, it does lead to some of the optimism that we were talking about earlier today. I think it's very hard to quantify, right? Very hard to quantify. So we're aware of it, generally in the sense of optimism. How much one can do through executive order versus through actual new rulemakings and new legislation, I think is a little bit unclear. I've heard other people say to me, hey, maybe the rollback is not as great as we would like, but at least it's no new regulations. I've also heard that expressed, and I think that there's a genuine feeling underneath that. And so I don't dismiss it, but I will say it's hard. We have to wait for it to show up in the data before we can really make sense of it.
Another question. Yes, sir.
Yeah, so tax code is very, very exciting, very enthused about it. But when you look at the tax cut 10 years in the future, right now companies have this big windfall. But you can see that windfall being competed away by lowering prices, increasing wages, so that 10 years from now, the profit margins of last year are the same as they are 10 years from now, but prices are lower, revenues are higher, but margins are thinner. What have you thought about that? How will that impact inflation?
Now, this is a question that has come up in a lot of places. Will the tax cut lead to a competing away of the advantages so that margins stay high?
Right. Or so the margins fall even. Well, I get your point. Some people have argued, generally speaking, I think most people think the tax cut will be inflationary. But there are some people who say maybe it'll be disinflationary for the exact same reasons that you talked about. I think those are probably the minority of people. I think more people think it's going to be just net stimulative, more spending over the next decade. Honestly, we just don't know. It's far too soon to tell how businesses are going to respond. Is it going to lead to more investment? And then the competitive dynamic. I ask a lot of businesses, why aren't you raising wages? They say, well, we can't pass the costs on to our customers, is usually what they say. That to me is an expression of anchored inflation expectations. Because if everyone together assumes, if everyone in the room just makes the assumption that you cannot pass cost increases onto your customers, none of you will raise prices and inflation will be anchored. So again, I'm not trying to talk around your question. It's a long way of saying I don't know the answer to it. We need to see how it plays out. I wish I knew. Do you have a thought?
It seems to me that's what's going to happen. That it will be competed away, and 10 years from now, in my opinion, the prices will be lower, margins will be where they were last year, and that'll be better off for
Back there, yes, sir.
I'm a little concerned about the VC inflation math. In my industry, construction, real estate, commodities, materials, they've been over 3% for the last couple of years. Our wages in our industry is 3% or higher the last couple of years. And then I'm being told it's 1.5% inflation. And that's not what I'm experiencing in the American.
Right.
Sectoral inflation question, construction and raw materials prices rising. So it isn't uniform across the economy, but there are areas in which inflation is higher.
And look, we agree, there's no perfect measure to try to capture what families are experiencing or what businesses are experiencing. But I would argue the U.S. has as good or better inflation estimating capabilities than any other country in the world. And there are professional economists who do this all day long, looking at a basket of goods, making adjustments for things like cell phones and the quality that's improving in technology. Right, there are other sectors of the economy where prices are plummeting. Right? So one of the arguments for why inflation's been so low in 2017 is that cell phone pricing plans have collapsed in the last year or two. That's actually true. So for every anecdote that, well, this one thing is much higher, I can point you to something else that is actually much, much lower. So these baskets are trying to very dispassionately look at the goods and services that are produced in the economy and to make the best dispassionate estimate of what's actually happening to inflation. So I'm not disagreeing with you at all. I'm just saying I think that these measures are actually incorporating construction as one component of the broader U.S. economy.
Let me follow up on what he said, though, and ask you, we do see commodity prices rising again. And you talked about companies saying they feel like they can't raise prices. But do you sense any pressure building on them where they will have to, because their margins are going to get so small, and a CEO's responsibility to his shareholders is going to be to deliver those profits? They're going to have to, at some point, raise prices. Do you see that coming?
I haven't seen it. I mean, I ask this question every time I travel around our district and ask businesses large and small, are you raising prices? And usually the answer is no. And so your guess is as good as mine. And they'll not only point to their domestic competitive pressures, they will point to global competitive pressures. Or they'll point to Amazon. And they'll say, well, Amazon, it's the Amazon economy now. Now, I think that's overdone. Keep in mind, productivity is low. Productivity growth is low, so it's hard to reconcile these different things that are happening at the same time. But some people say, well, we're competing against businesses in China. We can't raise prices here. I'm not going to dismiss them saying that. I'm sure there's some truth in their markets. There probably is some truth to that.
Neel, I think you're spot on. And Whole Foods is not increasing prices. With Amazon as the owner, to your point. I mean, I agree with your observation on disinflation.
Other question? Yes, sir.
Typically, the economic cycle span 7 to 9 years or so. Technically, 8 years out of the last recession. I feel like it hasn't been a boom time, but it's been an extended period of economic growth. What do you attribute the long run of expansion? And is there a catalyst that you're looking for that would turn the side?
Turn it down?
No, that would result in a turn in the economy to the negative.
To the negative. Do you want to repeat those?
Yeah, the economic cycle in history has been 7 to 9 years or so. We're very long in the tooth by that measure. Do you see any end to it soon, or anything that would lead to an end?
Well, Janet Yellen, our former chair, who I've got great admiration for, had I think this is her quote, where she said, economic expansions don't die of old age. And I think there's a lot of wisdom beneath that. Usually there needs to be some catalyst. If you look at, I've done a lot of analysis with my researchers on the flattening and inverting of the yield curve. So typically when short rates go up above long rates, it's been very common that a recession would follow in the US within about a year or so. Well, what does it mean when the yield curve inverts? Typically, if you look at yield curve inversions, the Fed has done it. Right? The Fed has embarked on a tightening cycle, which has then pushed the front end of the yield curve up. The back end has been anchored by broader economic forces, and that has often ended the expansion. So what could end the expansion? One thing that could end it is if we get overly aggressive in monetary policy and prematurely raise interest rates and invert the yield curve. That certainly could be a way that the expansion could end. Now, obviously, the Fed has not done that in the last 8 years or since 10 years. So I think that has contributed to the relatively benign economic environment that we're in. Other than that, other shocks could hit us, whether it's oil prices could all of a sudden surprise the upside. That could be a big shock on the U.S. economy. There are geopolitical factors. There could be shocks in Asia or in Europe that we're not seeing right now that could have spillover back to the U.S. economy. Those are all possibilities. We don't see any of those on the immediate horizon, but we never do.
We're going to have to let you go in a second, but that leads us up maybe to a perfect last question. You mentioned your former chair, Janet Yellen. Jay Powell is now in charge, first meeting in charge coming up in March. How are things going to change?
Well, I don't know that they are. I mean, I think I've had the privilege of working with Jay for the past 2 years. He's an excellent governor. He's a very serious, thoughtful policymaker. He's pragmatic. He's not an ideologue. He listens. He wants to forge consensus. I think that he shares a lot of those traits with Janet Yellen. And so I don't think any of us are anticipating major changes. Obviously, each leader has their own characteristics, has their own style, and Jay will bring his own experiences to the job. But as of now, I think it's going to be a continuation, which is good.
He's not an economist. You're not an economist. You're an engineer by training. Does that make a difference?
You know, the Federal Reserve System, we have more PhD economists than any other organization in the world. Literally, we're the biggest hirer of PhD economists every year out of PhD schools in the country. So we're not short of PhD talent. To me, I think the key question is getting the best ideas from them and bringing their best ideas to the table. And I think Jay is going to be very good at that.
All right, last question. Are you optimistic, pessimistic, cautious, nervous? How would you describe your view of the United States and the economy over the next couple of years?
You're not going to like this. You're going to laugh. I'm cautiously optimistic, and I'm cautious. I'm cautious because all of you are so optimistic. That's what makes me nervous.
All right, Neel Kashkari, thank you very much.
Thank you very much. I appreciate it.